Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and how you invest. I'm Stacy Smith, and thank you for joining us. And I urge you to hit the subscribe or the like button as you watch the program. The long anticipated rate cut by the Fed has finally happened, and that sparked the markets to some new all time highs, but it also led to some higher increases in some yields. We'll take a look at why that happened. Also, does the Fed rate increase mean there are concerns about the economy? We'll talk about that. And it is a presidential election year. So, should politics play a role in how you invest? With me to talk about the economy and investing is my panel of advisors and financial experts, and they are Carrie Coghill of Coghill Investment Strategies, based in Pittsburgh, also Frank Rossetti of HF Management Company, and Michael Godwin of Fregasso Advisors. One of our regular panelists would be Kim Forrest, the founder of Boca Capital Partners, is a little under the weather today and could not join us. She'll be with us, I hope, the next time. Now, since the last time we met, the markets have surged ahead with two of the three major indices setting new all-time highs. The reason, of course, goes back to the Fed's decision to lower interest rates by 50 basis points or 0.5%. So, Frank, you have stated you are not interested at all in a hard or a soft landing. In fact, you don't want to see any landing at all. You just want that economic plane to keep flying and never come down. So, my question to you is your take, though, on what happened with the Fed last week and lowering interest rates by 50%. I mean, 50 basis points, I should say.
The Fed, as expected, lowered interest rates. The question was whether they were going to do a quarter and a half. And as the time got closer, the odds makers, which never ceases to amaze me that we now have bookies betting on Fed action. So we have odds makers, and they were 60 some percent thinking that it was going to be a 50% cut before it happened. The last I saw. That being said, the market pretty much did what you could expect it to do. It first it went up, then it went back to where it was, and then on Friday it went up again. Today it's kind of flat at the opening. I haven't looked at it in a few minutes. It may have changed. More interestingly, but not unusual, the 10-year Treasury yield went up after interest rates. The overnight rate went down. Now that needs to be explained a little bit. The overnight interest rate, as we all know, is the rate the Federal Reserve charges banks for borrowing money from them overnight. It's a one-day interest rate. It really, I hate to say it, it really doesn't have a lot to do with anything. It's really the other interest rates are the price of money, and that is dictated as much by demand as by what the Fed says. That being said, since the overnight rate was dropped, it's reasonable to assume that the demand for money will increase. So the 10-year Treasury went up to reflect that possibility because that should be stimulative to the economy, hence the market. But we get back to what's got the market kind of flat right now. We're looking for earnings. As Kim, who's not here, often says, earnings in the end drive the market. And earnings reporting season for the second quarter are wrapping up, coming in pretty much a little above expected. Not a lot, just a little. And in the third quarter, if they keep going north, we'll probably reach for GAAP trailing earnings an all-time high. We've been at an all-time high in operating earnings for a few quarters now. So I think the interest rate thing is interesting. They're expecting more. It should be stimulative to the economy, and the concern is, does inflation come back as a result?
I'll just pick up right there because I think that, when this rate cut happened, what we saw, and Frank was discussing this, was we saw longer term yields go up. My first reaction to that was, oh, the market is expecting inflation from this, because if you overstimulate the market, then what happens? You have inflation. So I do think that the market is interpreting this maybe as too much stimulus that may drive inflation up, which is why you're seeing longer term yields go up. Now, The bigger question is, why did he do a half a percent? And that really has to do with the jobs market. I think that when we listen to the dialogue after the Fed meeting, he cited the labor markets really as being the main reason as to why they felt that this was not too much of a cut. We have seen the labor markets slow. I personally don't think it has slowed enough to justify getting aggressive on cutting interest rates. As you know, my position on this is be careful what you wish for, because it's somewhat unusual to see this kind of a cut when we actually have economic data pretty stable. So it's going to be interesting to see what they do from here in terms of continuing to stimulate an economy that doesn't seem to be broken. They're trying to get ahead of it, and that's really the point. And the labor market, I can understand to a degree why, but we'll have to wait and see how the numbers continue to play out.
So basically, you're saying that the all-knowing Oz, in other words, the Fed is not necessarily all-knowing. I mean, let's just go back to when inflation started to hit. It was called transitory. Mm-hmm. So I guess what I'm saying is how much faith do you have to put in the Fed in this situation?
I mean, you said it. Like, they're not magicians. You know, do they have information that we don't have? Yes. Do they get the information a bit before we get it? Yes. But are they predictors of the future? No. And that's why I get so frustrated by this conversation when you hear people predicting, oh, the Fed's going to lower rates 7 times. The Fed doesn't even know they're going to do that. So we put this expectation on these people that don't know exactly what's going to happen. And then you get other things coming into the marketplace, like potential strikes, that could have an impact on inflation, supply chain, etc. So, you know, at the time that Powell made the statement that he believed inflation was transitory, but no one knows what lies ahead. And that's what makes this so difficult. And that's just the way it is. And that's why for people in our positions, we have to make sure that for our clients, we're creating all-weather portfolios that are aligned with our clients' goals. So, you know, we're trying to create certainty out of uncertainty. And there are a variety of ways that we do that for our clients. And one of them is not placing bets on where we think interest rates are going.
Stacey, you're on mute, I think.
Thank you. I have some background noise going on. I'm trying to make it so it doesn't interrupt our program here. What I was going to say, Michael, is that the last time we met, you indicated that as opposed to our other 3 colleagues, you felt that you looked at things as a glass half full. Do you still look at it that way after the Fed's action?
Yeah, I mean, again, I think I to Carrie's point too, I think the economy's still on firm ground. It's doing pretty well. Consumers are still spending a lot. The unemployment rate is still historically low, although it's creeped up a bit. And I think that's kind of what the Fed's looking at. Anytime, historically speaking, Stacey, when the unemployment rate has increased by about 50 basis points or more, a recession has ensued, historically speaking. And we did that. You know, the unemployment rate troughed at like 3.4% or something like that. And we're up to about 4.2% now. And so the Fed, I think, looks at that and gets extremely worried that the employment conditions are going to continue to deteriorate. And that's why they went and aggressively cut rates by 50 basis points, despite the risk to inflation in 2025, which I think is something that certainly could spark going forward. And that's kind of what Carrie and Frank pointed out as to why the longer-term treasury yields backed up a little bit more. So again, I still think the economy looks pretty solid. But nevertheless, a couple Fed officials came out this weekend and today saying that more rate cuts are warranted in the back half of the year. and the market is expecting a total of at least 4 rate cuts all in by the end of 2024. So that means at least another one in November and at least another one in December, based on market predictions.
Let me say one thing. There's some things that no one's saying. There's an elephant in the room, and it's really a bear. It's called China. China's economy is collapsing. Germany's economy is not doing well. These things should ultimately affect us at some point in time. We seem to be impervious to it up until now, but that historically has not been the case. These things tend to impact us as well. If China, a huge consumer, quits consuming as much in the way of commodities, you probably, and we are seeing oil prices go down partly as a result of that. We could see prices in other commodities go down, which are not inflationary, but they also could slow our economy down more than the glass half full that Mike's talking about is expected to happen. I'm just saying that there's things to worry about if you're looking for things to worry about, and that's one of them.
Okay,
Well,
I'm not looking for things to worry about. Excuse me, Kerry, but there was an article in the Wall Street Journal recently that said, sorry, the Fed can't save us from a bear market. Now, is that kind of what you're hinting at, Frank?
I don't even think the Fed doesn't worry about the stock market. The Fed's job is to worry about inflation and employment. It's not even their job to worry about the economy. Inflation and employment, that's their dual mandate. All right. So if the market is impacted by what they do, that is not their intent. That just happens.
Okay, sorry, Kerry,
yeah,
go ahead.
it's not supposed to be their intent. I'm a little bit skeptical anymore. They're not supposed to be political. They're not supposed to be, yeah. But what I was going to say to Frank's point about Europe, we had some numbers out overnight this morning about the PMIs, which is just an indication of activity in Europe that came in below expectations. So there is more to worry about than just interest rates and what the Fed is going to do with interest rates. And no, I don't think that the Fed can save us if we were to go into some sort of a bear market. There are a lot of reasons that could cause that. I mean, if we go back to the 1990s, you have international currency crisis, you have hedge funds failing, things that really are out of the Fed's control. And let's not forget about what's happening in the Middle East right now in terms of things that may influence, not necessarily put us into a bear market, but you look at the impact that could have on the price of oil. And, we're not as dependent as we were anymore, but that causes global instability. So we have to really keep a wide lens, much further beyond what the Fed is doing when it comes to how we're making decisions for our clients.
If you guys can hear the noise in the background, I apologize for that. Can you hear me all right?
Yeah.
Okay, great. Michael, you are the Chief Investment Officer for Vergasso Advisors. So that means that one of the things you have to do is advise on asset allocation. So my question is, with the rate cut and everything we've just talked about so far, if there is a slowing in the economy, are you changing your look at how you allocate right now?
That's a good question, Stacy. When you look at asset allocation, and you should be doing this, every client, every investor should be doing this with their advisor, and you come up with your overall asset allocation to meet your financial goals, right? Whether that's going to be 70% of your overall portfolio in equities, 30% in fixed income, et cetera. And that allocation you set up, that ends up determining like 90% of your overall returns longer term. So that is such an important piece there. But as we talked about before, there's always times that you can make tweaks to the portfolio. So within that 70% of equities, for example, you don't need to be tied to the S&P 500 or tied to X, Y, and Z. You can make a tweak to if you want to get more defensive conservative, own more low volatility stocks, own more high quality stocks, own more low beta stocks, etc. And I don't think we're at the point now where we want to be doing that yet. I still, as I mentioned, I think the economy is still doing pretty well. I think stocks are expensive, without a doubt. And at some point, if the unemployment starts to get worse, as the PMIs that Kerry mentioned before look to be trending lower and lower, then you might want to get a little bit more defensive. But changing an asset allocation within a portfolio is something I think investors should rarely do unless they have a major life event that warrants it. You can always make tweaks within the asset classes to either get more defensive or place a tactical viewpoint on something that you think is going to happen in the economy or based upon where we are in the economic cycle. But actually adjusting your asset allocation based on your views in the market is something I would advise clients and investors not to do.
Yeah, go ahead, Kerry.
I was going to say, we take a little bit of a different approach when it comes to asset allocation, because one of the important elements of asset allocation and determining that asset allocation for a client is really their their risk tolerance. And as markets change and dynamics of the market change, you get a feel for what a person's real risk tolerance is. So when we're looking at events like what we're seeing happen now, a move like having rates go down like they did last week, and understanding what impact that has on various sectors, it doesn't necessarily cause us to say, let's change your asset allocation, but it very well may be a trigger to rebalance back to target. So you figure if you have an asset allocation to oversimplify, 60% stocks, 40% bonds, every day those percentages change. So when these events happen, we have to say, okay, where are we with our allocation? And is this now a good time to rebalance back to target? So if we look at how the bond market reacted and has reacted to this rate decrease, seeing longer term yields go up, that may cause us in some situations to want to rebalance if we're underweight bonds, where we might want to actually put more money in bonds. Now, I think the one thing that all of us do as we're working with clients is it's not a one size fits all, because we have clients that whether they're taking income, whether their risk tolerance is higher or lower, there are times where we will rebalance for one client and not rebalance for another client because the risk tolerance is different. We might have capital gains and tax situations that we know that the client can deal with the added volatility, and why take the tax consequence versus a client that gets really nervous about the market, maybe has a tax consequence but is in a lower tax bracket. So there are other things that influence a decision about when it is time to rebalance. But I would say that these situations, like an interest rate move, they definitely impact the decision making as to the timing of those rebalance moves.
Frank, historically, it's been a 60-40 ratio. Am I right on that, or was it 70-30?
Yes, I mean, that's been the common ratio between equities and bonds. It's expanded somewhat for some people nowadays, since alternative assets have become available for a wider investor base. And people are introducing illiquid, and that's important. It's illiquid. You can't sell it. Assets to portfolios because we can now, and but it shouldn't be overdone. I mean, I'm in that business, and it's a challenge, and the reason is they're not liquid, and you see events transpiring that aren't good for one or other asset that you own. There's nothing you can do about it except ride it out, and if you can't deal with that of those events, because they're going to happen, you shouldn't be in those markets. But the allocations it used to be they said that as you get older that 60-40 should rise and there should be more bonds. I'm older. I don't subscribe to that theory. I think that that's personal, as Kerry says. Those are individual decisions, not blanket things. I think blanket ideas are commonly useless.
I want to go back to the Fed rate cut here, and I can't remember whether it was Kerry. I think it was Kerry who kind of brought this up in a way. The Fed is not supposed to be political, but we have this. I like the little smiles we got right there. The Fed, though, did decide to lower interest rates right in the midst of a presidential election. I'm not accusing the Fed of doing it for one side or the other side, but does that affect at all how you take a look at your portfolio as to the politics that are coming up?
I mean, the political situation, and we get this all the time. How is the election going to impact our portfolio? I'm not sure if that's the question that you're asking.
Sort of, yeah.
Yeah. And the reality of it is that the election, and we're actually a lot more focused on the congressional elections, because really at the end of the day, what we want to know is what party controls the House and Senate and what party controls the White House. And that dynamic is much more important in understanding what kind of policies you may or may not get. So leading up to the election, generally it's a non-event. I mean, it's kind of hard to say in this political climate, but where we get really focused is after the election. Nothing's going to change overnight, and sometimes things don't change at all. So you really have to look at, right now, what we're doing is really digging into the different potential changes that these candidates could put forth. As we know, what they say in a pre-election period is not generally what they say after they get elected. But it's just kind of doing our homework right now so that we're ready to actually take the test, so to speak, after the election, and we can see what dynamics play out. And, most of this is related to taxes, estate taxes, the sunset of the tax cuts that we had happening at the end of next year. And the good news is we have some runway. We're going to have some runway to be able to do the appropriate planning based on what the outcomes of the election are.
I think what Kerry said, the Fed, to your point, Stacey, they're not supposed to be political. I like to try to believe the best in people there, but I'm sure some of their biases come into play a bit. But if they truly are data dependent, it was likely they were always going to cut 50 basis points. They were always going to cut 25 basis points, bar none, regardless of the election or not, last week. And 50 basis points to them made more sense. The market was already predicting that. So the data kind of proved out that that's what they were going to do, I think. In regards to trading around politics, the data just shows that that's not a smart thing to do from the broad market standpoint. Going all the way back to 1938, we looked at the data there. Whether a Republican or Democrat are in office, the year after a presidential election, both Democrats and Republicans, whoever controls the office, market does great. Full 4-year terms, again, the president doesn't impact the markets all that much, right? The state of the economy when the president's in office dictates that. But whoever's the president does not wield the power to move overall markets. Can they impact certain fragments of the market, certain companies? Absolutely. But to make wholehearted investment changes based on one political candidate versus another, that's a fool's game. That doesn't work in the end.
I would say that I agree with everything people are saying. I don't believe politics has a lot to do with it. I think the captains of industry have more to do with it than the politicians. And however, Kerry's point to taxes is very well taken. The sunset of the tax laws from 2016, who knows? Until we know who's in Congress, we don't know how that's going to be treated. The options, there's 3 primary options. They let them sunset and it goes back to the way it was. They don't and they amend it, or they renew it exactly the way it was. Personally, I don't think the first and the third one are more likely than the middle one. I think that they'll probably amend it somewhere, but until we know who's there, it's pretty hard to say. If it's a Republican controlled Congress, both sides of Congress, the president will probably see a renewal of the old law. Now, who's in the White House? Well, we don't know that either.
Yeah. Okay. Good. I want to move off that for just a second and move on to something else. There was a report in Bloomberg on this Monday morning, that there's a potential for a dock workers strike that could begin on October the 1st.
Absolutely. The real question is it a short strike? Is it a long strike? You still have a week and a day. You have 7 full days to go. It may get settled at the 11th hour, as often is the case. I think I want to believe that most of the Christmas goods are in the stores. They're not on ships anymore. I mean, there may be straggling stuff that still has to come in. So it probably won't, I don't think it would impact Christmas too much because they're starting to roll that stuff out already. I think they have it. And so the post-Christmas thing, it's probably less of an impact there because basically people are paying bills more than buying things in that time after the holidays. So if I'm right and the stuff's already in the stores, the impact might be less than it would have been had they done it maybe June. And that being said, if it goes on and on and on, it's going to create all sorts of problems. Look back to a couple of years ago when we had supply chain issues. I mean, you couldn't get things. I mean, the shelves didn't have all the products you might like. And although we've been working on building our industrial base, that's not like flipping a light switch. That takes years to recreate, and if not decades. And that being said, we're still dependent on the rest of the world,
Stacey,
and this certainly would be a problem.
Sorry, Frank, I didn't mean to cut you off there, but
that's okay. I was done.
This thing will get resolved, as Frank mentioned, one way or the other, and like most likely sooner rather than later. I think the worst case scenario here is it drags out a little bit, and you have a temporary spike in certain types of goods inflation. Right? You need a washer, dryer. Maybe that spikes up because there's 100 ships that are just docked half of a mile outside of these ports, waiting for the ports to reopen. And once they reopen, all the ships come in and do it. But we've dealt with this a lot over the past few years, whether it's the COVID one, whether it's the United Auto Workers shutting down in Detroit for a number of months. And I've had a couple blocks in the Suez Canal with a couple of Chinese shipping containers. They all resolve themselves. It doesn't result in a material spike in inflation, at least outside of a very short-term impact. Again, shutting down the entire eastern seaboard from a port standpoint does sound pretty bad. But again, I can't imagine that this wouldn't be resolved in a relatively timely manner. But again, it could impact in, I think, short-term spikes in inflation, but you'll see that dissipate in the months ahead, certainly as soon as it gets resolved.
And now we're hearing Ford the United Auto Workers are talking about a potential Ford strike that's in the news. So, these things happen, and to Michael's point, they never get resolved before the final hour, because if they do, someone failed. So, we'll see how that plays out. But these things generally are temporary, and if you do see market volatility over them, they're generally buying opportunities.
Okay, well, that makes sense. Basically, what you're saying is take all of these things with a grain of salt, but be prepared in case something does happen.
Yeah.
Yeah.
I mean,
okay.
But I will say, this goes back to the client, right? If we've got really nervous clients that don't have, can't stand the volatility, like these are all the things we think about when we're creating allocations for our clients. 60-40 isn't a given. We may have someone that could never live with 60-40, so they have to be, 40-60.
Right.
So, yeah, it makes our job very interesting.
That it does. It's been an interesting discussion today. I want to thank all of you once again for joining me for The Bull, the Bear, and you, and we hope to see you the next time. Thanks for joining us.